Today on the show, we are talking about, when do you remove the adult leeches from the financial budget? Our audience is getting older, it seems, and so are their kids, which is fine. We'll talk about offset accounts. We're going to have a chat about moving to the country to work. Is that worth doing? And paying off the mortgage early. I am joined by Rach, Kroon and John Pidgeon from This Is Property. It's also available here on YouTube or wherever you listen to this podcast. I'll start by asking the people with children in the room. Claire asks, "Hi everyone, I'd love to know your thoughts about when to fully cut off adult children financially. It's something hubby and I are struggling to decide on. We're still paying for our 23-year-old, nearly 24-year-old's top private health insurance. They said if they have to pay for it themselves, they would cancel it. Hubby is on decent money, so we can afford to keep paying if we do it. If we want to, we can afford it. I don't want them to be without it, but when it's time to stop, when they can actually afford it themselves, but without it, when is it time to stop when they can actually afford it themselves but choose not to?" The old horse to water helicopter parent situation, which I've got no idea about. Who's got the oldest kids here? Oh, you've got a 23-year.
I do.
Yeah.
Okay, so
Case in point.
is old mate still on your policy?
I think he may be.
Right.
I think he may be.
Right, okay.
We should-
Have you had a discussion with old mate?
Is that by default?
Most other things have stopped when he finished university though and started working full time. So things like that, and we were doing a lot of different support. But he's also living out of home now, which is different. But the private health, and Claire, I understand it. It's something I really want the kids to keep, and it may be something that I would continue paying for. And I think they can only stay on until they're 25. I think there's a limit. Yeah. So I think in my mind I was just going to continue until the 25 mark.
Yeah.
Is it something, and I know nothing about insurance, but is it something about them living at home versus not?
No.
Is it, no?
I think it's an age thing.
It's an age thing.
Okay.
Yeah. And
What are your thoughts?
Nah, they're paying for their own.
Okay, so based on that, if you're like, all right, kids, these are the reasons that you should pay for it. These are the reasons not to. We're not paying for it anymore. Enjoy life on your own.
Yeah, look, and I think it's a bit of, for me, it's cutting the cord and saying, right, you got to stand on your own 2 feet and you're not going to be hand-fed until you're 45. But, I mean, when it came to the crunch, I'd look at my 23-year-old, 23,
Yep.
and say, well, are they studying still? Like, what's their income levels like? It doesn't seem as though this person's income level is that great. So
I jumped in and had a look at the comments. It's a full-time salary of $93,000.
Oh, but they're paying for it every day of the week.
I mean, send
If
this.
that
Okay,
helps.
Yeah.
Claire, send this clip to your 23-year-old. Honestly, you just need to pay for it and get on with your life because you'll pay more in tax, not more in tax than the cost of the cover, but effectively it works out that you pay a small gap. Actually, I don't have it here. I did the exact comparison in my first book, but you just have to bake it into your budget and get on with your life. If you want to, strip out the freaking, get rid of all the extras, do minimum hospital cover with the highest excess, just keep it because you really want this if you're over 30 or you're earning over the threshold of the day, which I think is around 90 or 89.
And to add to that, Claire, the way you could get it across to yourself, because you've got to tell yourself a good story on this, because it's an emotional cord that you're cutting, isn't it? You say, like, okay, son, you go and pay, daughter, you go and pay your health insurance. We're going to put the same amount away into a separate account, and we may decide to give that to you at some stage, but you've got to stand on your own 2 feet. You're earning good, solid money. It's an important part of your life. Go and do it.
Yeah.
That's my thoughts.
Yeah, okay. So the income threshold at the time of recording is 100K or less. So,
Yeah, so-
I'm still doing it.
But if she were to say, I'm not going to have private health cover if I have to pay it, and that's a lot of people of that age, 22 or 23, even if you're earning $93,000 a year, you may not choose to spend that monthly cost on private health. And if as a mum, I would choose to pay that rather than have my child not have private health.
Yeah, well, I didn't have it at that age, and I was a bit blasé to it, and having no real no home I was living in as an asset, and obviously no dependents and things like that. I'm like, okay, well, I can keep myself healthy and I'm all good. Like a blasé way to look at it, but so I probably get someone in their 20s can easily think that I don't need it, but yeah, as a parent, it's a different conversation, isn't it?
Her income will be high enough probably the next year that she has to have it. Because that's when you go over the threshold, you really have to have it.
Look, at the end of the day, do you want to pay, and honestly, it's going to be probably $80 a month for a 23 or 24-year-old. I don't know. It's not going to be that much. And get a massage once a quarter if you do have the extras. But you got to go back to the fundamentals. Okay, let's do it this way. And we might put a link to the clip or whatever in the show notes. If they didn't have it, there's flashpoints where you need to get it in Australia, I believe.
Yes.
If you're under 30 and you're earning over 100K income, you need to get it because you'll get taxed more for not having it. I'd rather not pay the government as much tax and pay that to somewhere that I can at least get benefit.
Yeah.
Or you're over 30, turning 31, and that is when each year that you don't have the cover, when you do decide that you need it, you'll pay more for it because you'll get a loading. So I'm actually okay if Claire's son or daughter, I don't know if it was daughter. I couldn't
I'm pretty
see.
sure
It might have been in the comments.
I think it was in the comments that she said she's earning $93,000 a
sweet.
year.
So if they're under 30, which they are, and they're earning under 100 grand, if they don't want it and they're good in health, don't have it. Get on with your life. But if you're over 30 or you're earning over that threshold, I think it's a no-brainer. But we need to know the reasons that we do have private health insurance. It's not for the extras. It's not for the massage. It's not for emergency treatment. It's for the voluntary surgery in hospital. Voluntary hospital stays. That's all you get private health insurance for. Yeah, sure. Go get $30 back when you get your teeth cleaned. Sure, go get $20 back when you get your massage. If anything, get it. No extras or minimal extras. Highest excess possible, which will be the $750 for hospital. Minimal hospital coverage. Just bake it in. So Claire, send this to your child.
Yeah. As a 20-something-year-old, you're not worrying too much about your corned beef, are you? It's more about your hospital, and as you said,
I've not heard about that saying before about the corned beef.
teeth.
Ah,
I had no idea.
never heard of that.
Absolutely.
But I would also say,
They should be in good order.
I honestly think my advice to Claire, if you don't want to pay it and the child is working full time, cut the cord. You might have some type of threshold in your life that, and this is for people that aren't Claire, we've got kids that are on our private health insurance. We have a fork in the road. As soon as you move out of home or get a full-time job, that's when we're stopping it. So as long as you're living at home or studying and living at, or just have some type of thing.
Yeah, and it may be just a point, because it sounds as though they've been wrestling with this for some time to make a decision. We've made a decision in 30 seconds, not emotionally, of course, but where it might be a good time for those two to sit down and say, well, what else are we doing for them? And getting the kids in the room and saying, all right, now we're wearing big person pants. What's your life look like, sort of thing? And because we're having this conversation at the moment, Ames and myself, where Max just got himself a vehicle.
Oh, what are you getting? A ute?
Yeah,
So
What
exciting.
type?
a Nissan Navara.
Navara? Yeah.
Navara, yeah. Any case, yeah, he's going to have tyres, he's going to have insurance, and there's rego and all this. So, I'm like, okay, the boy's got responsibilities now. He's earning a little bit of money. What do we pay for? What does he pay for? So sometimes we're butting heads on what we should be doing and shouldn't be doing. But I think it's really important to continue to have those conversations around, it's not just all take.
I'm honestly be more important because Claire will send this clip to her child. I'm more wanting, and now I'll talk to the 23-year-old, I want you to do a budget and a spending plan. I want you to actually get your income insurance. You think you're having a heart attack about paying for private health insurance? Your income insurance is probably more beneficial for you because you'll probably have a higher chance of claiming on that if you're in good health otherwise. But we just want to bake in these things to our budget. So as we progress over time and save and invest, we're not stealing money from a category that we need in the future to come. Literally just bake it in. If you had to choose income insurance or health insurance for under 30, I'm doing income insurance all day long. If you're under 30 and have that higher income, I'm doing both.
Good stuff.
Also, do what you want. This episode is brought to you by Sphere Home Loans. Hey, this is wild, this. And we're doing these did you know things just to make it a bit more educational. A good broker wouldn't suggest you move banks or lenders if they don't think it's in your best interest. Now, not only that, I believe by law that any mortgage broker and certainly the team at Sphere Home Loans have a legal obligation to act in their clients' best interests. If only they had that for real estate agents.
Jeez, on a real estate agent rant.
Yeah, last episode, everyone, I had a bit of a rant. We're doing 2 eps back to back. But
poor people.
is that true? Sorry.
You know what? It's called bid, and it's absolutely true.
Best
Can I
interest
give you a
duty.
fun fact?
Go for it.
We had somebody come to us from the podcast this week that it was in their best interest to go direct to a bank. And Karen was very upset about it, but she actually said, you actually need to go direct to the bank because of this reason. And it was just a police officer on a workers' compensation payment. And there was a particular bank that just did that, that we're not on panel for. And you've got to do it. You've got to work in their best interest, whether it's in your interest or not.
And to back that up, I got an email from a client who also said the same thing from your team, that they said to go direct because there was going to be a better outcome. So yeah, you are the real deal, Rach.
So if you're a police officer and you're on a sort of, one of those workers' compensation payments, there is no better lender for you than Police Credit Union.
Well, as there should be. It's there.
Really? That's a blanket statement.
Mm-hmm.
But if you're not on workers' comp.
Yeah, only if you're on that workers' compensation because they understand it better than anybody else.
Yeah. Yeah, love it. Well, my name is Glen James. This episode is brought to you by Sphere Home Loans, and you are listening to Money, Money, Money with Rach Kroon and John Pidgeon from This Is Property podcast. Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11 or if you're just getting started. Let's get into it. Thank you so much for being here today. Okay, this one here, I thought it was an interesting thing to talk about in the show. Grey Mouse said, and this is an example, my friends, this did not need to be a nickname. This could have been a real person because it's not sensitive unless you're embarrassed, but that's fine. I don't think you need to worry about being embarrassed because we all ask questions. Is there any kind of calculators to compare having money in a savings account versus having it in an offset for investment property? Brain not functioning with the figures today. So what I kind of, and there was a heap of people that answered the question, but I just wanted to talk about offset 101 and just to remind people, and we might even look at the negatives or the disadvantages of offset accounts because there could be some. Basically, you just need to work out that if your savings rate, and I did this number here, if we had $20,000 in a savings account at 4.5%, that would be $900 a year interest. Now, if we had $20,000 in a savings account at 5.8%, that would be $1,160 per year. which basically means $260 extra. So the reason that I just wanted to do it fundamental first, and tell me if this is a crap way to explain it, is the 5.8 could be considered the mortgage interest rate. The 4.8 is the savings rate.
4.5, yeah.
Sorry, the 4.5 is the savings rate. The thing that I wanted to really highlight, this interest here, if 1160, that is interest saved, not paid, right? If it is against an offset account. So you're not earning that interest, you're just not paying it. Now, the $900 per year in your own name, that is actually taxable. So the advantage of the offset account is, sure, you're not earning the interest, but in theory, you are not paying an extra $1,160 in interest to the bank. But the advantage is the amount of interest not paid is also an amount that is in theory compounding the other way. So remember, compounding returns, it's interest on the interest. With offset account and not paying interest, you're compounding on saving interest on interest. So it's a negative correlation. Is that a crap way to explain it?
No, it's a good way to explain. I suppose to go that little bit further with the offset is if you've got a principal and interest loan, the principal is paid down, right?
With that offset savings.
Yes. So you're making the same repayments, but it's just that amount is going down on the principal, not being saved on the interest. So it's creating equity in your property. Whereas if it's interest only, it's actually saved money.
Yeah, how I would explain it would be, and this is for an investment property, but let's assume that it's an owner-occupied property just because it makes it more simple to work out. If it was an owner-occupied property, you would be getting $1,160 tax-free per year, and if you put the money in a savings account, you would be earning $900 interest, which you would then be taxed on.
Yeah.
But because it's an investment property, it changes.
Yeah. So, but you're still saving. You're still a better outcome, regardless of whether it's an owner-occ or an investment.
I would have to work. You have to work it out.
No, but what Glen's saying is you're taxed on the profit.
Oh yeah.
Yeah. If it's not in offset, that interest is getting.
I would always say use offset rather than a savings account. But
Yes.
Now I just want to get an accountant to work that out for me exactly what it would be, because it's an investment.
But you've got to look at it, and particularly the advantage when the offset account is your own home. In theory, this is where the magic is. That $1,160 of interest saved, right? If you're on the highest tax rate, for example, and you wanted to pay down that $1,000 of interest, you'd have to probably earn $2,000 because it's tax-free. And that's the real power of using offset account on your principal place of residence. Now, back to the thing with the investment property, it's still it's not as sexy because the debt is deductible anyway. So you still are having interest saving compounding rather than earning interest compounding and being taxed in your own name.
Yeah.
So as I've drawn here, if there was $200,000 mortgage and you had $20,000 in the offset account, that $20,000 is offsetting. So $20,000 minus $200K is $100,000, which interest is charged on.
180.
Now, let's talk about the disadvantages of offset accounts, because everyone froths on it, but these advantages, the one disadvantage I'm thinking of can offset all the advantages. And what do we think that is, kids?
Well, you can get your mitts on it, can't
it's
you?
the behaviour side.
Yeah.
Yeah.
So you could take that $20K tomorrow and go and buy a handbag.
Yeah. So that's why I don't think it's a problem when, ever since we've started this podcast, the questions that have come in and it was like, oh, I've received $200,000. Even last episode question, what do I do with it? John always defaults to throw it in the offset account because his shtick and internal constitution is I'm good with money. My internal thing is pay down the mortgage. You know, if you need the money later to invest, you just set up another mortgage. It's not a big deal. So it is that behavioural thing.
And I've seen that behavioural thing in real life now, where if I had that money in an offset account, my husband would spend it because he's a spender and he would find a way to spend it. So I have an offset account that is now completely blanked out. Like I think if you are a spender, you can still use offset. You just need to blank it out. So you can put a circle around an offset account and call it savings and not have it on your card, not have it on your app, don't have access to it, and you can still have it in offset. So you've got to have those offset accounts that you can't see if you've got someone in your life that loves to be a big fat spender.
Yeah, that's a good point. Yeah.
You know who you are.
You're listening.
So one thing I would say as well, this is particularly important when it comes to the emergency fund. And in fact, I did an episode at the start of the year on the main show here about emergency funds. And I full on crunched the numbers. I still think it's okay if you are a little bit spendy like me. You know, if you see something, I need to find money to put it, like, to buy it. Like, if there's money on the table, I'll find a way to spend it type thing. I crunched the numbers using offset account and a savings account that's direct with taxable interest. If behaviour is a problem, it's okay to have your emergency fund in an online bank account, not with your offsetting your mortgage. Because at the end of the day, the win, it's, you know, if you spent it and you have an emergency, well, who cares how much it was offsetting the years before you got cute and wanted to buy a holiday with your emergency funds? Like the emergency fund in a bank account that's an online saver, the difference in spread, so that $260 extra that you are foregoing, that $900 per year that's taxable, highest tax rate, call it 450 net income interest. Highest tax rate, $260 extra per year, probably goes up a little bit. I think what I'm trying to say is, if it costs you an extra $500 a year not to have that money on offset, but it's out of sight, out of mind and going to be there when it is an emergency, that's called the insurance premium for having the emergency fund. And because you do have your emergency fund, it will enable you to increase your waiting period for income protection, increase your excess on your home insurance, increase your excess on the car insurance, because you do have that emergency fund. Sure, it's not on the offset, but sure, we know that the money is there. When you look at the whole situation, the fact that you've got that emergency fund, you're probably saving thousands a year on your insurances anyway because you're self-insuring the first higher excess.
And not all savings accounts are going to give you 4.5% either.
No.
It could give you zero, depending on what you've got set up. But maybe for Grey Mouse, it's a case of one of the first questions to oneself is what's our mindset around money and spending habits, etc.
Love it. We'll be back right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
Okay, we are back. I think when this is going live, very soon, maybe next week when this is live, we're doing a live show, we as in I, in Auckland. Wednesday night, the 18th of February. If you're a Kiwi and you're listening and you're in town, come and say hi. I'll drink you, I'll feed you. We'll have a bit of fun. We'll play a game. We will do a Q&A. I always like to give people the off-the-record goss when we do a live event. It's like, yeah, John and I had a big fight and no one knew about it. That type of goss.
So I'm not invited to this one.
And John, yeah, I kind of just did it without John because it's not running at a profit because there's no sponsor for it. So I'm just...
When you love to be in Glen's world where you just, I might just go to Auckland for a minute.
I want to look after the listeners, Johnson.
I know, and I love that.
I want to feed back some of the money that we make with this enterprise.
Love it.
I don't love running things at a loss, but sometimes you have to.
What a lovely city to go and do it in as well.
That's right. So details below. Oh, and one thing, everyone, just make sure you are buying the tickets from Eventbrite. That's the website. Someone needed the link the other day in the Facebook, and I just Googled money, Glen James live in Auckland. And there are mirror sites that sell tickets that obviously sweep the likes of Eventbrite and Try Booking and all that. And it looks like it's the actual site.
Yeah, right.
So it's pretty good to be successful when other people are trying to scam off your name. What a pain in the ass. So yeah, make sure you use Eventbrite for the tickets. All righty then. This is for you, John. Torquay celery. We have the opportunity to move to the country for work and lease our principal place of residence. It's a well-lived-in house for 10 years. Whether it's 10 years old or they've lived in it 10 years old, you decide, everyone. Is there anything we should do cosmetically before an open house to rent it out, like repainting it, or is that not necessary? It's still nice and there are not big issues, but it'll just freshen it up and would it make any difference? I don't want to spend money if we don't need to. I mean, you're probably just renting that out, aren't you?
Yeah, we don't need to spend too long here, I wouldn't have thought. Great to be moving to the country, and that's happening quite a bit, mind you, which is a great thing to be doing. How long are we moving away for? Probably, we don't know the answer to that maybe, but yeah, understanding how long that might be. Sounds though it's in good nick, so I wouldn't go crazy doing any repainting or carpets or anything like that when it's going to be rented. So generally speaking, as a rule, people won't look after it as well as you do. So I would leave it. The tax benefits also, not that you may be thinking about this, but you may want to rent it first and then get a feel for what it's like. And then when the tenant decides they want to move out, you might want to freshen it up then. Just from a tax point of view, you might be able to claim it in that year as opposed to adding it to the cost base when you sell it.
Yeah.
But I'm not a
Good idea.
qualified accountant.
Yeah, we know that much.
Yeah.
For housekeeping, because as you were talking there, I just had a look. We have the opportunity to move. So this isn't you have to move to get priority if you want to be stationed at Belmont Police Station type thing. So I'm thinking opportunity to move, it could be more money for them for a period of time.
Yep.
Go out there, do a smash and grab.
Yep.
The house, they could be furnished accommodation. So that's also a way to really build wealth by not doing that. And then career op. So just as a side to that, I'm saying the fact this is an opportunity, awesome that you're leaning into it. Because a lot of times in life, we need to do stuff and maybe see it as this is an opportunity that we can really dial up our money and tick all these boxes, going on an adventure and all that. We own the house, doesn't mean it's forever. Rach, would you get a valuation when they move out on the house, just to have that on file?
Absolutely. So get a valuation because it's an important date to get your paperwork in order when you actually move out of a property because the purpose is changing from owner-occupied to investment. And you may very well move back in and make it an owner-occupied again. But you need to know what it was valued at when you moved out, because so evaluation's important.
And, I'm just scribbling here. We don't need to tell the bank that we've changed it from owner-occupier to investment property, and probably
No, you don't need to make a change. A lot of people do, though. So a lot of people will make a change because you may very well lease this property out long term. It might become an investment property long term. A lot of people would change it to an interest-only loan if they moved out, if they were going to buy something else, and then you would do a fundamental change. But you're not obligated to. And if it was me, I probably wouldn't change anything because I'd probably continue to pay P&I if I was moving out and not quite sure of what the plan was.
Unless, I just had a wave, unless they were saying, well, hang on a minute, when we return from this country hiatus, we're potentially going to sell it and upsize or something like that. So, or like I suppose where I'm going with that is think the next maybe 5 years, 10 years to know what that next play will be, as opposed to just leaving it as is.
I think the reason I said, through that underarm throw to Rach around the vow, like they've lived in this home for 10 years, right? They're going to the country. I think there is a higher chance they won't move back there.
They're staying.
No. Like if they move back to the area, upgrade the house or...
Yeah. Okay, so let's play that out for 2 seconds. So if they are doing that, what are you doing with the loan then when you depart to the country?
I think the important thing is the reason, because they've lived in this property for 10 years and it's gone up probably an incredible amount in value at that time, the reason the valuation's important is because let's say they don't move back and let's say they sell it.
I'll draw this based on 500K purchase price 10 years ago. So
So it's gone up a certain amount of value. You need to show what it was valued at the time you moved out, because if they moved to the country for 3 years and then decided to stay and then decided to sell this property, well, there's going to be CGT, capital gains tax.
On the 3 years growth.
But if you don't have a valuation, they can use a different formula. So the valuations are important at any time. And you know what? You're probably going to do a bit of a financial health check at the time you move out of that property. You're going to get your bank or broker to probably do some numbers and work some things out for you. Get them to do a val at the same time. Stick it in your filing cabinet, move on with your life.
I suppose from a financial structure point of view, what you might just consider before we move is to say, well, okay, if we go Glen's way and then when we come back from the country, we're going to potentially sell it, then just keep paying it down and it's going to be more of a cash grab later on. But if you're coming back saying, well, we've had enough of that property, but we've got a nice cash deposit, we'll go and buy something else and we'll turn that into an investment, that's when we may be looking at an interest-only loan in that period.
Yeah, possibly.
Yeah. So, and I think just to close the loop here with some concrete numbers, if 10 years ago it was purchased for 500K, now we'll assume that it's worth $1 million right now. We're going to get the value now to lock that $1 million valuation in now. Now, in the future, whether that's 3 years, 10, 1 year, whatever that is, if it did sell for 1.5 million, we're only paying capital gains tax on 500,000, the difference between the 1 million and the future sale price, which was the reset value, as opposed to paying the full $1 million gain.
Yeah, and if you didn't have a valuation, there'd be some other way they'd work it out, but it would be a different method, which could cost you.
Yes.
In average across the whole lot.
Now, and then in practice, it really means you've got that valuation, you go out to the country, live there a year, no, we don't like it, move back home, probably don't even need to use the valuation ever.
Yeah.
But at least it's in the pocket.
And didn't cost you anything.
No. So I probably would say, because I don't know, we're going beyond the scope of this question, but I just think it's good to chat about. In practice, what I would personally do, move to the country, put a tenant in, don't do anything to the house. Lock it in for a 6 or 12 month lease. In 6 months or 12 months, you'll know if you're staying in the country a bit longer, another year, you might hate it, whatever that is. At that 6 months, if I'm probably still not doing anything unless there's maintenance required. But one of the properties after there was a long-term tenant, between tenants, I recarpeted. It was like less than $5,000. Like just freshen this up, put new carpet in, not the cheapest crap possible. Let the tenants trash it over the next 3-4 years. Don't care. Carpet's cheap. Like let's make this feel like a home type thing. But yeah, I'm probably not doing anything. And then in concert with, if you were thinking, oh, we really would like to paint this or really would like to recarpet it, and it probably does cost me money because I'm of the view, why do I want people to live in something that I wouldn't want to live in? Now, that's probably cost me money. But in between tenants, if you think, oh gosh, we really do need to get this painted, do all that stuff in between tenants so it's already online and is the investment property, back to your point.
Yeah, I think the more I think about that, if I'm moving back into that property, I'm probably not doing a whole heap to it other than just keeping the tenant nice and happy.
Yeah. And then if you do move back, refresh it before you move back in.
The 6-year rule might come into play as well there in that that phase when they move out. So they may not incur too much at all in the way of capital gains tax.
Yeah. But I just think, we don't want to spend money we don't need to. I don't think you have to spend any money. Just go for it and just stagger it over time. If you're like, yeah, we're really going to, because you're going to be, I'm thinking potentially saving money on your accommodation costs. So this could be a really good opportunity for either a higher income, higher savings let's take that and go out there, do your time, print some money, come back and do what you want. I think it's a great thing.
Round up the cows.
Moo, moo, moo.
Smell the country air.
Okay, Jeff, this is a bit of a community section of the week, but we might finish with that. Have you got 5 minutes, Rach?
I have 2.
2 minutes. Rach has 2 minutes. Do you want to?
It's okay, I'll do 5.
Okay, we'll do 5.
I guess speaking.
And then Rachel's got to go. Adventurous octopus. Looking for advice. Our goal is to pay off our mortgage within 10 years, but we're not sure of the best path. Married, 35 and 46, with 2 kids under 3. Combined income 161. Wife working part-time. PPOR worth 1.2. 650 owing. 80 grand in offset. No other debt. We're considering an investment property to help pay off our PPR sooner, but unsure if we're already maxed out. An investment property is the right move, or 500 to 600k properties still make sense anywhere. What would you do in our position? Feeling a bit stuck in the rat race and really would appreciate any direction. Anonymous as co-workers / family are in the group. We will answer this right after the break. Okay, we're back. I think we call out the obvious in the room. 3 kids, combined income 161.
2 kids.
2 kids, combined income of 161. A 650k mortgage, call it, just under 600, depending on what the offset fluctuates. It's going to be feeling tight.
Yeah, we haven't got a savings figure there, so hard to work that out. But it's an aggressive goal to pay that mortgage down in 10 years, which is fantastic. So well done on the aspiration.
So for the purpose of time, John, can we still get 500 to 600k properties elsewhere? And then I'll ask Rach, based on just her looking at that, is there lending? So you reckon you still can get 500 and 600s?
We can, yeah. Yeah, there's good property around the country for 500 to 600. No problems about that.
Should we, if we want an investment property and the difference was we can buy it tomorrow for 600 purchase price, or get through mat leave or working part-time or getting back to work, wait 12 months, get the incomes up to buy an investment property for 850 somewhere else, what are you saying? Do now with what you can, or wait and buy a different asset?
I don't know how much they could borrow, but I think the cash flow is the issue not necessarily how much they can borrow.
I agree completely. Even if you could borrow,
I mean, servicing surely isn't there.
I wouldn't say it's not there,
Okay.
but I would say affordability is what I'd be more concerned about. And sometimes when you've got a part-time income and you've got 2 kids under 3, your position's going to be really different in a few years' time. So I just really want to look at, if I was looking in front of these clients, whether they could afford to buy an investment property or not, I'd really want to see their budget, see what their savings is, really think about if this was going to put them in a more difficult position by putting them in an investment property. Do I think they should buy an investment property one day? Absolutely, I do.
Yeah,
it's just about whether it's right for them now.
Yeah. So there's kind of 3 things. One, do you want to kill yourself and being in a pinch for the next few years for the sake of having investment property? Probably not ideal. 2, do we wait till servicing increases, which inherently would help with the cash flow thing anyway? Or 3, we understand the bed that we're lying in, we'll just go and get a 500K.
Yeah, and most of this, I'm not a psychologist, but
Yeah, we know that much as well, mate.
The 10 years thing is grinding away at them. They want to get that mortgage done.
Yeah.
If it takes 12 years, not the end of the world. And the feeling that they're in the rat race, like we all go through those stages. So just sit back and say, well, actually, we're going okay, but we can only do what we can physically do financially. Let's just do the numbers. So you go through the exercise.
Numbers. And I would, if I was Adventurous Octopus, even whether it's the right for them to buy now or not, what I would do is reach out to a mortgage broker, get the numbers done, so I can see it in front of me. If I bought a property for this is how it would look repayment-wise. This is what you can borrow. Here's what it would look like. And at least that way you can tick it off your
Wondering list.
Yeah, get it off. Get your head out of the sand. Look at the
What do they
numbers
say?
and
Better
make a
off
decision.
Dying not wondering or something like that?
Yeah.
Better off not dying of wonder.
I just think you got to lean in and get all the information.
Yeah. Do you know any good mortgage brokers?
I don't.
No. She knows excellent
some
ones.
great ones.
Yes. Cool. But I really want to call out, you've got 2 kids under 3. It's normal to be, I don't know, like it's hectic. It's hectic.
Yeah. But look, you want to bite off more you can chew, then just
Have a nibble.
yeah, but understand.
And I think the
situation.
question as well is if, we're not sure of the best path, there's usually only one way to pay off a mortgage sooner, and it's to put more money into it.
Or buy, I guess if you've got the ability, if they bought another property, they've had this property and they've got the equity in this property over the last, say, 10 years, if they'd bought another property at the same time, they would have had that growth in 2 properties. That's a very quick way to pay off a mortgage in a faster way is by
So
holding
you
2.
made them feel bad.
Sorry.
By not buying that second
But I
property.
understand. But a lot of people think that way now. They look back
Yes.
10 years ago. If I'd bought another property 10 years ago, I'd be in a different position. I don't want to miss the boat again, so I want to do it now. But it's got to, in theory, would you be better off holding 2 properties? Yes. However, if it doesn't fit with your lifestyle and your cash flow, it doesn't fit.
Yeah,
It doesn't work.
but the Manly Ferry is going to come again in half an hour, isn't it, in terms of the boat, right? You don't miss a boat that's a boat that's never coming back.
Yeah. I'll just finish. There is another way potentially that can be done. The 80K that's in offset. I wouldn't want to commit the whole 80 to this endeavour. You could, in theory, pay down the mortgage, 80. So that's paid down, re-borrow 80K and invest that into equities. And that's kind of just a traditional kind of gearing / debt recycling thing. So that's also a way that that you could do it. So yeah, have a chat with Spear Home Loans, see which way he's running. Don't die of wonder, and then we'll finish with Jeff in the Facebook group. And if you do need to walk out anytime, Rach, go for it. For all first home buyers who bought an existing property, what were the first things that you have upgraded from your property that made a lot of savings, i.e. solar, heating and cooling, less flow taps to save water, etc.? There were a heap of issues there. We didn't actually print that out, did we?
No.
That's what I did. It's really small to read. Can you read them?
Can that, whack these on a little.
That was my omission. Claire says, depending on where you live, solar powered, southeast Queensland based, worth it every time. I think we'll just scrub through because there was a lot that said solar.
Yeah, and roof insulation I'm seeing a bit of as well.
Yeah. Someone said definitely not flow taps. I took the restrictions out of the shower that I needed that pressure. And that's it. Like, sure, you could have the water flow taps and all that stuff. You probably won't see material savings in if your water bill was, I don't even know how much water is, $60 a month? Probably not even that. Well, $30 a month, you might get down to $29.
Yeah, depends on how big the house is and whatever, how many kids and whatever you've got. Sealed the garage is an interesting one. Crim safe, like you've got to appreciate security.
Yeah. Diego said, replace carpets if applicable, fully service air cons and fix any drainage issues like rusted gutters or downpipes, then low-cost cosmetic upgrades such as paint touch-ups and landscaping to make it enjoyable.
Yeah, the biggest one I take from that, like we like the solar thing, it does really depend on where you live, I reckon.
Yeah.
Speaking to people.
Yeah, if you're south-facing living in Hobart, maybe not.
You're not getting, whereas one said southeast Queensland just killing it.
Yeah.
The installation is a massive one for not having to turn the heater on every 5 minutes too. So insulation in the roof or the walls. So that's probably one that's a really good investment that wouldn't improve the value of your house, but definitely reduces the costs.
I think the thing that we need to look for is made a lot of savings. So we're not taught, like, sure, there was the comment there about gutters and all that. There's two categories. It's like, do we want to make this nice and livable, or do we want to invest for the future for savings?
Yeah.
It's got to be, where is the biggest money from your cash flow coming from? It's going to be electricity.
Yeah, it's heating and cooling.
And cooling.
Yeah. Sealing your garage probably does not a hell of a lot to go towards that.
But one thing, if you are looking for your first home, part of the pest and building inspection, just check if there's insulation because it makes all the difference and it's not expensive.
No.
I mean, you could probably get your house done for $1,000. Yeah. I don't know.
Depends on the size of the house.
I mean, I think the reason that I say that is with all the insulation that we did at the studio here, the stuff that I got was bloody expensive. And then the comparison quote was, if you just use, run-of-the-mill house stuff, it was like they were paying me to take it type thing. Yeah. Like it was so much cheaper. Yeah. So that's where I came to.
I think one...
LED lights as well.
Yeah, LED. Like one that goes maybe under the radar a bit is, one mentioned there, the crim safe on the windows and doors. That's... Having that on allows you to keep the doors and windows open during the night.
In summer,
which keeps the airflow coming through. So, it's obviously a safety thing, but it's also, airflow thing.
Yeah. Draft proofing. Well, that's the inverse thing. Yeah, if you've... It's funny. Who was I talking to the other day? Someone was saying... Oh, it was actually, Nick... who wrote the Quick Start Guide to me. Whoops. There's the book. He's in Spain, and I called him the other day. I'm like, what are you up to? He goes, we're going to look at a new rental. I'm like, why? Are you not happy? He goes, we've just had a really cold winter here in Spain, and you feel the cool air in every room coming through the windows.
Oh, really?
So he's like, this is just not livable. Ah. So...
Because it's moved? Or
just the seal, like
seals.
Just... older place. I don't know, but that's kind of that drought proofing.
Yeah.
Draft
proofing, yeah.
Look, there's lots there. You can just search in the book for home buyers or solar and it will come up.
Yeah. Replacing carpet, added vinyl flooring, don't know.
But that's got to be the lifestyle vibe.
Think so. You would think so.
Remember when we did that show in Tamworth? I used the Tamworth in Townsville. We should do a regional show.
Yeah, we've got to go regional.
All right, we'll do that. I'll get you out there, Johnny. We'll get Johnny out there.
Get the
I always wanted to buy a van, sticker it, and take the van on tour.
Dumb and Dumber sort of.
Yeah. Harry and Lloyd. When I jokingly said about carpets in the house, and everyone like gasps. It's like, no, you don't have carpet up here.
No, goes mouldy.
I went up to Townsville. No, not Townsville. Airlie Beach and Cairns when we did the cruise.
Oh, yeah. It's hot. So outrageously hot up there.
Oh, mate, it's just another world.
It is.
I'm such a winter baby. I cannot do humidity.
Yeah. No, you're staying south.
Absolutely. Well, friends, a bit of fun today. Thank you so much for listening. You can find John on the This Is Property podcast on YouTube as a show with video as well. If you found this episode useful, why not share it with a friend or family member? Thank you so much for having listened. We've had a lot of fun. My name is Glen James. That was Rach. She had to leave to go to a meeting. I can't believe she's still doing meetings.
Must be a A-grade.
Must be a listener of the podcast she's meeting with.
Meaning A-grade.
Yes. And this is John Pidgeon.
Yes.
We'll see you guys soon.
Bye.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.